folks. Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. It's been a pretty volatile past couple of trading days. As I speak, the S&P 500 is right around 3,900, which is still in that band that we've been in kind of for the past 3-4 months, kind of between 3,800 on the low end in late December up to about 4,200 on the high end in early February. We've given a lot of those early February gains back. S&P 500 now sitting at about a 1.6% gain for the year. And a lot of that has been driven by this continuing seesaw battle between, is the economy too hot? Is the economy too cold? And what does that mean for corporate earnings? What does that mean for the Fed? What does that mean for all of that? So to give you a brief recap of history, as we came into December and early January, it seemed like inflation was cooling and almost cooling too rapidly, that the economy was slowing down maybe faster than everyone wanted it to. And as a result, people were really worried about the R word, the recession. So sort of this side, if you will, graphically of the teeter-totter. We're worried that we are falling into economic activity slowing down so much that it's really going to present a problem for corporate earnings, and all of the other problems that normally go along with a recession in terms of unemployment, et cetera. So markets were a little worried about that. And then as we moved into January and February, we started to get better news around the economy. Economy maybe a little bit stronger than people thought. Unemployment looking pretty good. And wage growth not falling off a cliff. So we started to think, maybe we're not going to have a recession. And then as we've gotten into, very late February, early March, the narrative has shifted to, well, maybe the economy's too strong relative to where we thought it was before. And so maybe that means that the Fed isn't done raising rates. And indeed, Powell came out in testimony a couple of days ago and said, hey, look, we slowed the rate hikes to 0.25%, but we can always go back to 0.5% if the data indicates that we're not slowing as fast as we'd like to, and that inflation isn't under control. And indeed, the economic data has continued to be, I think, a little stronger than people would like. If you look at the jobs reports that we've gotten this week, unemployment claims have been a little lighter than people might like. We added 311,000 jobs in February. That's a little faster than people might like. Although I would note in that report was a little bit of a mixed bag, because the unemployment rate actually ticked up a little bit, and wage growth was the lowest month on month that has been in a year. But still, on the balance, the preponderance of evidence points to an economy that is cooling slowly, but maybe not as quickly as the Fed would like to get inflation under control. And that puts us on this side of the teeter-totter in terms of, well, maybe the Fed has to, raise rates a little bit faster. And you've seen that in the forward interest rate curves. Previously the expectation was around maybe 5.25% was where the Fed would be done. Now those rates are probably up around 5.75%, so 5.75 before the Fed is actually finished raising rates. And that's a relatively modest move, but it's still enough to move the market around a little bit, particularly when you throw in what's going on with bank stocks, which we will talk about in a second. I'd just like to note that as you're kind of, moving back and forth on this teeter-totter, that is the path, at least in my opinion, that we're going to be on if we are slowly walking forward towards a soft landing for the economy. You kind of want the argument about, is the economy too cold or is the economy too hot to be active? Because if it's all one-sided and everybody just totally agrees, yep, the economy is too cold, that probably means means it's too cold. If we're having this debate where we're moving from, is it slowing too fast? Is it not slowing fast enough? My guess is, or my hope is, in a couple months we'll be talking about, is it slowing too fast again? That's the path where you eventually wind up with happiness. So it's frustrating from a news flows perspective, and it makes for a very volatile market. But I think that's the way it's going to remain for the foreseeable future. Meanwhile, in banking land, there's been what is probably not a household name for most of you prior to yesterday, was Silicon Valley Bank, or SVB. This is a bank that obviously does a lot of banking out in Silicon Valley. And they reported earlier, a couple days ago, that they had lost a lot of money in their investment portfolio. And as a result, they were going to try and issue shares to sort of shore up their capital reserves. And that share offering failed. And so now there's a big crisis, because whenever you get a run on a bank, that run on the bank is very difficult to stop. We've talked about this before. There is no Jimmy Stewart in the lobby, encouraging people out of the goodness of their hearts to not take money out of the bank. And so once you get a run on an institution like that, it is very, very difficult to get it to stop. And I think the common narrative, which is probably true, is that, in that bank's investment portfolio, they had probably a little bit too much venture tech, et cetera, that's gotten beaten up, which caused the losses, which then subsequently caused them to raise capital. And if you get a bank that has a failed capital raise, well, that creates a big problem for confidence in the bank. That confidence is really an issue that is confined to Silicon Valley Bank. This is not an issue for certainly the broader banking sector. They are not out there reporting massive losses in their investment portfolios. However, the broader banking sector is selling off, and I kind of want to explain why, because it's not the case that everybody needs to panic out of all of their financial stocks. Banks are generally in the business of borrowing short and loaning out long. That is the way that most of them make their money. They take in deposits from depositors, people who want to buy CDs or open savings accounts or open checking accounts, all that kind of fun stuff. They take in those deposits and they pay you a little bit of interest, because you're generally loaning the bank the money for a very short period of time, or maybe even not at all. And in the case of a savings account, you can get your money back at any time. And then the bank is turning around and loaning that money back out at like a 30-year mortgage rate or a 15-year mortgage rate. They're out there in the marketplace, financing homes and financing businesses and doing all of these longer duration loans. And that works really, really well almost all of the time, except when the yield curve is inverted. Because if you're a bank and you are borrowing money from your investors or from your depositors at CD rates of 4.5% or 5% or 6%, and then you're turning around on a 30-year home loan and loaning it out at 6% or maybe 6.5%. That presents a real problem for that net interest margin that you earn between those two, the amount that you borrowed and the amount that you loaned at. It's a short-term problem, so long as the yield curve eventually becomes uninverted. But when you see the inversion get steeper, which is what we've seen in the past month or two, as once again that expectation of where the Fed's fund rate has come up without necessarily moving the long end of the curve that much, that puts increased pressure on bank margins. And that's really the story as to why banks have been selling off in the broader market sense, is really that pressure on net interest rate margins, not necessarily, oh my goodness, all of these banks have a bunch of bad investments on their balance sheet. So as always with that, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you soon.